Have you ever sat across from someone genuinely wealthy and felt like they were speaking a completely different financial language? Like they understood something about money that nobody ever explained to you, and that they were not exactly rushing to explain? That feeling is not your imagination. Because the people who have built real, lasting wealth are operating with a set of principles, strategies, and mental frameworks that almost never make it into mainstream financial advice. Not because they are hiding them out of malice, but because these ideas go against everything the broader economy profits from you not knowing. Today, we are pulling back the curtain on 6 of the most powerful secrets that genuinely wealthy people almost never talk about openly. These are not tips, they are not tricks, they are fundamental truths about how wealth actually works. Truths that will make you look at every financial decision you make from this point forward in a completely different way. Welcome back. I am Warren, and on this channel, we say out loud the things that most financial conversations leave unsaid. If you are ready to think about money the way the wealthy actually do, hit that like button right now, subscribe, and let us get into the 6 secrets. Every one of these secrets challenges something most people have been taught, shown, or conditioned to believe about money. Some of them are going to feel uncomfortable. That discomfort is valuable, because the beliefs that need to be replaced are the ones that have been costing you the most. Secret number 1. They do not work for money. They make money work for them. This is the foundational secret that every other one on this list builds on. And it sounds simple enough that most people hear it, nod, and then go back to doing exactly what they were doing before. Because truly internalizing this idea requires dismantling one of the most deeply rooted beliefs in modern culture: the belief that your financial value is determined by how many hours you work and how hard you are willing to grind. Rich people understand, at a structural level, that there is a ceiling on what any individual can build through labor alone. There are only 24 hours in a day. There are only so many years in a working life. And any income model that stops paying the moment you stop working has a fundamental limitation built into it. Not a flaw, a ceiling. The shift from working for money to making money work for you is not a motivational concept. It is a practical restructuring of how income flows in your life. It means acquiring assets, investments, income-generating properties, businesses, intellectual property that produce returns independently of your time. It means building systems that earn while you sleep, while you are on vacation, and eventually, while you are retired. Every dollar invested in an asset that generates returns is a tiny employee working on your behalf around the clock. The wealthy have armies of these employees. Most people have none. The practical starting point is simpler than most people expect. You do not need to quit your job or launch a business tomorrow. You need to direct a consistent portion of every paycheck into assets that grow independently of your effort, and then protect and grow that pool of assets over years and decades. The 9-to-5 does not stop, but it stops being your only financial engine, and over time, the gap between what your assets earn and what your job pays narrows, until the day it reverses entirely. Secret number 2. They understand that financial education is the highest return investment they will ever make. Here is a question worth sitting with. How much time did your formal education spend teaching you about compound interest, tax strategy, investing, debt management, and building net worth? For most people, the honest answer is close to 0. The educational system is exceptional at preparing people to participate in the economy as consumers and workers. It is remarkably poor at preparing people to participate as owners and investors. Rich people have figured out, either through deliberate pursuit or through the examples of those around them, that financial education is not a hobby or a luxury. It is the most important skill set available to anyone who wants to change their financial trajectory, and crucially, it is a skill set with a compounding return. Every piece of financial knowledge you acquire builds on what you already know, improving the quality of every future financial decision you make. This is why genuinely wealthy people are almost universally continuous learners when it comes to money. Not obsessively, not anxiously, but consistently. They read about investing. They study tax strategy. They understand the financial products and vehicles available to them well enough to evaluate whether those products serve their interests or someone else's. They do not hand over financial decisions to others without understanding what those decisions actually involve. The practical implication is straightforward. Every hour invested in genuine financial education, understanding how markets work, how taxes work, how compound interest works, how debt works against you, will pay dividends for the rest of your life. Not metaphorically, literally. Better decisions, fewer costly mistakes, and a compounding advantage that grows more powerful every year. Secret number 3. They use debt as a tool, not as a lifestyle. Most people's relationship with debt is reactive. Something they need costs more than they have, so they borrow. And the borrowing feels normal because everyone around them is doing it. Financing cars, carrying credit card balances, taking personal loans for things that will depreciate long before the loan is paid off. Rich people have a fundamentally different relationship with debt. They distinguish sharply between two categories: debt that builds wealth and debt that destroys it, and they pursue the former aggressively while avoiding the latter almost entirely. Debt that builds wealth is what investors call leverage. Borrowing at a low interest rate to acquire an asset that generates returns higher than the cost of the debt. A mortgage on a rental property that earns more in rent than it costs in monthly payments. A business loan used to fund expansion that generates returns well above the interest rate. In these cases, debt is not a burden. It is an accelerant, a way of acquiring more wealth-building capacity than your current capital alone would allow. Debt that destroys wealth is what most people are carrying. Credit card balances at 18 to 24% interest. Car loans on depreciating assets, personal loans for consumption. This debt does not buy assets. It buys things that lose value. And it charges an enormous ongoing fee, in interest, for the privilege of buying them before you can actually afford them. Rich people refuse this category of debt almost categorically, not because they cannot afford the payments, because they understand that every dollar paid in high-interest consumer debt is a dollar that could have been compounding in an investment account instead. The practical takeaway is not to avoid all debt. It is to ruthlessly separate debt that acquires assets from debt that funds lifestyle, and to eliminate the latter with urgency while potentially leveraging the former strategically. Secret number 4. They think in after-tax returns, not gross figures. This secret separates people who are sophisticated about money from people who are not, and most people land firmly on the wrong side of this divide. Because taxes are the single largest expense in most high earners' lives, and most people spend almost no time thinking about how to legally and strategically minimize them. Rich people think about every financial decision through the lens of what it costs or earns after taxes. A salary increase from $90,000 to $110,000 does not feel like a $20,000 raise to someone in the 24% federal tax bracket. It feels like a $12,000 raise after federal taxes alone. A 10% investment return in a taxable account is not 10% if dividends and capital gains are being taxed along the way. The after-tax return is what actually lands in your net worth. This is why wealthy people maximize every available tax-advantaged account, because the tax savings compound just as surely as the investment returns do. This is why they structure businesses and real estate holdings with tax efficiency in mind from the beginning. You do not need to be a tax expert to apply this secret. You need to develop the habit of asking one additional question before any major financial decision. What does this look like after taxes? That single question, asked consistently, will improve the quality of your financial decisions in ways that compound significantly over time. Secret number 5. They build networks, not just skills. This secret makes some people uncomfortable because it can sound like an endorsement of nepotism or unfair advantage. It is neither of those things. It is a frank acknowledgement of how opportunity actually moves through the world, and a recognition that most people leave an enormous amount of financial potential on the table because they underinvest in relationships. Rich people understand that wealth is almost never built in isolation. Business partnerships, investment opportunities, career advancements, market information, mentorship, referrals. The vast majority of the highest leverage opportunities that drive financial outcomes arrive through relationships, not through formal channels. The person who becomes aware of an off-market real estate deal, an early-stage investment opportunity, or a significant career opportunity almost always becomes aware of it through someone they know, not through a job board, not through a public announcement, through a network. This is why genuinely wealthy people invest real time and genuine energy into building and maintaining relationships. Not transactionally, not with an immediate agenda, but with the long-term understanding that the quality of your network shapes the quality of your financial opportunities more than almost any other variable. They show up for people. They stay in touch. They make introductions. They share information and opportunities without keeping score. And over years and decades, the network they build becomes one of their most valuable and most invisible financial assets. The practical implication is simple, but requires sustained effort. Be genuinely useful to people in your network. Stay in touch with people who are doing interesting things. Attend events and join communities where people with ambitious financial goals gather. Give before you expect to receive. And over time, watch how the quality of the opportunities that reach you begins to reflect the quality of the relationships you have invested in. Secret number 6. They are obsessed with asymmetric risk. This is the most sophisticated secret on the list, and it is the one that most clearly separates the financial thinking of the wealthy from the financial thinking of everyone else. Asymmetric risk is the practice of structuring situations so that your potential upside is significantly larger than your potential downside, and it is the lens through which genuinely wealthy people evaluate almost every financial decision they make. Most people unconsciously treat risk as a binary. Either take it or avoid it. Wealthy people think about risk entirely differently. They ask, what is the worst realistic outcome here, and can I absorb it? What is the best realistic outcome, and how large is it relative to the worst? And is there a way to structure this so that the downside is fixed and limited while the upside remains open and potentially very large? This thinking shows up in how they invest. They do not bet large amounts on highly uncertain outcomes where both the upside and the downside are enormous. They look for situations where they can risk a defined, absorbable amount in exchange for an open-ended potential return. An early-stage investment where the total loss is limited to the amount invested, small relative to their overall portfolio, but where the potential return is 10 or 20 times that amount. A business started with controlled initial costs and gradually scaled as revenue demonstrates viability, rather than an all-in bet on an untested concept. This thinking also shows up in how they protect themselves. Wealthy people are meticulous about downside protection, insurance, diversification, emergency funds, legal structures, not because they are afraid of risk, but because they understand that the ability to stay in the game long enough to benefit from asymmetric upside requires never suffering a loss large enough to knock you out entirely. The practical application of asymmetric thinking is to ask one additional question before any financial risk you take. If this goes as badly as it realistically can I absorb that outcome and continue? If the answer is no, the risk is too large regardless of how attractive the potential upside is. If the answer is yes, and the potential upside is significantly larger than the realistic downside, you may be looking at exactly the kind of risk that quietly wealthy people have been taking and profiting from for their entire financial lives. 6 secrets. Make money work for you instead of always working for it. Treat financial education as the highest return investment you will ever make. Use debt as a precision tool, never as a lifestyle. Think in after-tax returns, not gross figures. Build your network with the same intentionality you bring to your career, and structure every financial risk you take so that your potential upside dwarfs your potential downside. None of these are secrets because they are complicated. They are secrets because the financial system, the banks, the advertisers, the consumer economy, profit significantly from most people never figuring them out. Because a financially educated, asset-building, tax-aware, network-rich, asymmetrically thinking individual is a very difficult person to sell expensive consumer debt and overpriced financial products to. Now that you know these 6 principles, the next question is the same one it always is. What will you do with them? Because knowing is only valuable when it changes something. Drop a comment below and tell me which secret hit the hardest. I read every single one. And if this video gave you a new way to think about money, hit that like button, subscribe, and share this with someone who deserves to know these secrets too. I am Warren, and I will see you in the next one.